a lot of the inflation that you see globally today is because of COVID. I think India handled the COVID situation extremely well. Absolute full compliments to RBI, full compliments to government for the way they handled this whole COVID situation. We did not go overboard. We did not keep printing notes and pumping liquidity in the system like some of the Western countries did. We did infuse liquidity, but we infused targeted liquidity to segments of the market which needed that funding. And therefore, we did not see tearaway inflation like the Western world. In fact, we did not. Inflation was pretty much reasonably under control. Then in February this year, 2022, you had the Russia-Ukraine war. And suddenly you saw a spike in oil prices. So our inflation that we see today, to a great extent, has been influenced by oil. Oil has a big impact on inflation because we are such a large importer of oil. The equation, as I understand, is like this, that any $10 change in oil prices, up or down, has about a 37 basis points impact on inflation. This is, I think, a CII report. And if memory serves me right, it's about 30 basis points impact on the fiscal deficit and about a 20 to 25 basis points impact on the current account deficit.
About 6,000 crores broadly.
Roughly. So oil impacts us, higher oil prices impact us. Because we have to pay more amount, it has an impact also on the currency. Plus, you've seen so much of foreign money being withdrawn. And I'll talk about why so much money was withdrawn out of India also. But the combination of all this has made the rupee a little weaker, even though RBI did a great job in terms of intervening, preventing the rupee from sliding as much as most of the other countries saw their currency slide. But it did have an impact, and the impact is reflected therefore in inflation, because what you're importing today, you're paying a higher price compared to what you were paying prior to the war. So that is inflation. In my opinion, interest rates have probably peaked. A lot of the interest rate increases that we've seen in India have been largely to provide some kind of stability to the rupee. Because the way the US Fed has been increasing interest rates, you're seeing money moving out of all emerging markets back into the US. So unless we keep our rates a little higher, we will see more money going out of India, which then has its own negative impact in terms of rupee weakening, in terms of inflation, and in terms of so many other things that happen. So our increase in interest rates has been more to support the rupee, to give some stability to the rupee, rather than to just tackle inflation. So I think that worst is behind us.
But
now,
ultimately, Mr. Mistry, it's also about affordability. I personally have a home loan. The interest rates at which I borrowed was 6.5. Now it's 8.5, and it is pinching me.
Sure.
So my question is that this kind of a spike in interest rate, which has happened in a compressed time of about 6 to 9 months, will have an impact on either affordability or demand. Somewhere it has to catch up.
All right. So first we must understand that a housing loan is a 15-year loan on an average. Duration is shorter because people tend to prepay loans early. Yeah, let's go.
We can keep on chatting.
Duration is lower because people tend to prepay loans. All loans are amortizing loans. So there is a principal repayment which starts the moment the loan is given. So a combination of amortization and prepayments results in the duration dropping to about 5.5 years. So the average duration of a housing loan in India is about 5.5 years. But on a door-to-door basis,
even on a 20-year loan,
even on a 20-year, on average is 5.5 years.
Okay.
5.5 years because people tend to make part prepayment of their loans, and also because it's all amortizing loans. And over the last 30 years, our experience is that between 10 to 12% of the loans outstanding at the beginning of the year tend to get prepaid each year. And these prepayments have got nothing to do with interest rates. It's not that people are prepaying a loan because interest rates are higher or interest rates are low. It's just that people tend to come early and prepay loans. So because of amortization, because of prepayment, the average duration is about 5.5 years. But on a door-to-door basis, it's a 15-year loan. Now, in a 15-year loan, nobody can give a fixed rate loan for 15 years. Everyone gives floating rate loans. When you take a floating rate loan for 15 years, you will encounter 2, 3, maybe 4 interest rate cycles where rates will go up, rates will come down, rates will go up, rates will come down. Because that is a normal thing you will see in any economy. So you've seen rates coming down very sharply because of COVID, during the COVID period. now rising sharply as a result of what we are seeing globally, largely because of that. And at some point of time, in my opinion, in a year's time, you will again probably start seeing interest rates getting a little low. Over a period of 15 years, it will all even out. So when you're taking a housing loan, it really doesn't make too much difference, Nikunj, whether you're borrowing at a time when rates are high or rates are low. Because if they are high, they will come down over the 15 years. If they are low, they will go back up at some point of time. So you will go through 3-4 such cycles during the course of those 15 years, complete service. So in a consumer loan or a shorter term loan, it may have more impact on demand. In a housing loan, which is a long-term loan, the impact on interest rates will be relatively much more. Thanks so much. Thanks. Thank you.
But, you know, Mr. Mistry, so the macro for Indian housing sector is well discovered. We all know that. India's underpenetrated, the desire to buy a house is always there. But this is one business where now the big PSU or big PSU banks are waking up. SBI is, thank you sir, SBI is very clear in terms of where they want to take their market share.
Yeah.
And their cost of borrowing, because they are a bank, is much lower than that of HDFC. And you've still managed to grow and keep your NIMs intact. So what's the secret sauce here?
See, Nikunj, competition is not something which is new. We have seen competition for the last 20 years or more. I would say banks started coming into the housing finance business somewhere in the late 90s. Today we are in 2022. 25 years we've seen competition. Sometimes a little more severe, sometimes a little less severe, but generally we've seen competition. But the important thing is that the housing market is so large, the potential is so huge, that nobody needs to do anything which is irrational. And therefore the pricing for housing loans has always generally kept pace. No one has gone and abnormally dropped interest rates. The other thing which you must keep in mind is that we have over the years really worked on every single aspect of giving a loan. It could be something as small as moving some piece of paper from one table to another. I'm giving you a silly example. So in the process, we have always, over the years, for such a long time, looked at how we can improve efficiency, how we can improve productivity, how we can reduce our costs. And that is then reflected in the fact that our cost-income ratio, which is your cost as a percentage of the net interest, is less than 10%. In March, it was 8.5%. 8.5% would probably be one of the lowest cost-income ratios you will see in a retail financial institution, not in India, not in Asia, but in the world. And when we meet investors, a lot of first-time investors, people now know HDFC over the years, but first time they hear of a cost-income ratio of 8.5%, they start feeling very excited. So that is one. Second is, because mortgage is the only business we have, we don't, unlike a bank, we don't have car loans and consumer loans and et cetera, et cetera. There is a huge focus on the housing business, and there is tremendous knowledge of housing markets all over the country.
Why is that there was so much of yes, no, I don't know when it comes to the merger? The views were very divided. The management, Mr. Parekh, the management of HDFC Bank, they had to literally go on road shows to convince shareholders that a merger acha hai. It will create shareholder value.
Sure. All right. So, first of all, rationale for merger. Why
it is not a forced merger. Let's first clear the air.
100%.
It's not
100% no. We have looked at this possibility of a merger not once, not twice, but many times over the last 15, 20 odd years. But in those days, the regulatory cost of a merger was just very, very high. And therefore, every time we looked at it, we just said, let's look at it, relook at it at some point of time. Then came COVID, and COVID obviously for 2 years, everything got forgotten. When we looked at it again in 2022, we found that many things had changed over the last 7, 8, 9, 10 years, which had now made the merger very, very conducive. And to my mind, the merger now will result in a situation where 1 + 1 will be more than 2. There's several synergies of a merger. I can run through those if that's of any interest to you. But there are many, many synergies which have always been there. But what has changed over time is certain facts. What has changed is that the reserve requirement, which is the CRR and the SLR, has progressively over the years come down. It's now down to about 22.5%. priority sector loans now, there are other ways.
You can purchase
Everyone
them
can do different things. Thirdly, interest rate curve. If you look at the interest rate curve today, if you borrow money theoretically and put it in a government security, you get a positive yield. Whereas there have been points of time in the past when it was a negative yield. Then RBI now permits banks to come out with these infrastructure bonds, so affordable housing bonds. So if you borrow 7-year money and use that money for affordable housing loans, then to that extent you have no CRR requirement, no SLR requirement, no priority sector lending requirement. So all of that significantly reduces the cost of a merger. These facts were not there years ago. Then you look at the fact that today we are carrying the nearly 45,000 crores of liquidity in the balance sheet. When we had looked at this in 2014, we were carrying probably less than 5,000 crores. So many changes have happened over time.
Price to book has also come down, which in a sense also made the merger slightly easier.
Price to book is a different way to look at it because it depends on how you look at book value. HDFC is not a single company. We are a conglomerate. So we have life insurance, general insurance, asset management, bank. The way we do accounting is that when we do our standalone accounts, we only reflect the dividend that we receive from these companies in our P&L.
Investments are in the book value at the
Investments always at historical cost. So our original investment in HDFC Bank, because its par value now is 1 rupee, our original investment in HDFC Bank is reflected at 1 rupee a share. Similarly, life insurance original shares are reflected at face value, at original cost, which is 10 rupees. So over the years, there has been a massive amount of appreciation in the value of these investments. And that appreciation is not reflected in the balance sheet, not reflected in the P&L account, only a line item in the balance sheet. So the market gives a huge holding company discount to that.
Yeah.
When the merger happens, so discounts are, I've seen discount of analysts going from 30, 35, 40, 45% even. So in the merged entity, there'll be no shareholding left in HDFC Bank. HDFC shares will all become
HDFC Bank.
and HDFC itself will merge into the bank, and shareholders of HDFC will get shares of the bank. So there will be no shareholding of HDFC Bank left. The unrealized gain on HDFC Bank itself was over 1,60,000 crores in September. Today will be a lot higher. And if you take a 40% discount on that, that itself is nearly 65,000 crores. So logically, when the merger happens, automatically you should see the market cap going up because there can be no holding company discount. Then you look at EPS. The profitability of the combined entity will go higher. But for a moment, forget that. Let's just look at profitability as it exists today. We own 21% shares in the bank. We are not going to sell those shares. We are going to cancel those shares.
They are not going to the treasury.
No, they are not going to treasury. We are cancelling those shares. So when we cancel the shares, the total shareholding, number of shares in the bank will come down.
So EPS goes higher.
EPS goes up. If EPS goes up, logically the market cap should also go up. So there are many, many such positives which are there. Cross-selling, huge cross-selling opportunity, whether it is in terms of housing loans, whether it's in terms of selling banking products to our customers, massive opportunity. So many, many such positives are there in the merger. But what happened was initially after the merger, there were a lot of technical issues. Uncertainty around MSCI. The biggest uncertainty was, will the combined entity be part of the MSCI or not?
But that,
fortunately, that has now got clarified.
So
and
just to clear the area,
just to tell you that one day when it got clarified, just that one fact, the stock was up substantially. So there are so many such myths, so many such doubts in people's mind, which many have got clarified, many will get clarified over a period of time. Take Nifty, for example. There was a question mark on Nifty. There was some analyst report which said that the data shareholders approve, HDFC will move out of the Nifty.
but MSCI part has been taken care of, Mr. Mistry. What about the local funds? Because as per the SEBI law, you cannot have more than 10% in a single entity. So yes, one broken end has been fixed, the other has not been
we will of course be talking to SEBI on that, but leaving aside that for a moment, the fact of the matter also, is that the moment the merger was announced, we started seeing that a lot of the local funds, knowing that they would have this limit, started selling one of the two.
You know, the pride of India are companies like HDFC Limited, HDFC Bank, not only in terms of the shareholder value, but the kind of franchise value they've created. But it's an irony that the holding of both HDFC Limited and HDFC Bank is still is owned by foreigners. I would imagine that what is the crown jewel of India should actually be owned by Indians.
Hopefully, if we see some change in the guidelines governing mutual funds where they can hold a larger amount of equity, a larger amount as a percentage of their funds, it will be great. But the real reason is that mutual funds in India really became prominent in the last, 15 years? And we've been owned by foreigners since the 90s.
And they never had the capital because you needed capital to grow.
And you needed capital to grow. In those days, there were not that many mutual funds in the 90s. I mean, I can't even remember. There was UTI, of course. And I don't think there were too many others at that time. So, in any case, foreigners had bought a lot of our equity right from the 90s. And we've been meeting investors since, early 90s. 92, 93, 94 onwards.
I've been told that
Then at that time, there were foreign ownership limits, 26%, 49%, 74%, and so on and so forth.
So how will life change for HDFC subsidiaries once the merger goes through? Because HDFC has listed some of the subsidiaries.
Sure.
Once you go to the bank, the outlook changes completely because the bank also has their own subsidiaries.
No, you have to look at it like this, that HDFC Bank today is a very large distributor of products for HDFC Life, HDFC Asset Management, HDFC Ergo. Today, there is no holding company subsidiary relationship between the bank and these companies. It's more like HDFC is holding all of them, so the relationship is through HDFC. So there's no direct, interest in. But when the merger happens, these subsidiaries will then become subsidiaries of HDFC Bank.
Yes.
So if they do well, then that, that the good part that they've done will get reflected in the balance sheet of the bank. So the bank will become a lot more inclined to be a larger and larger distributor of these products. So for these subsidiaries, it's a very good thing that happens because of the relationship, the distribution agreement that is there between HDFC and between the HDFC Bank and the subsidiaries.
Now, HDFC Limited on its balance sheet, they incubated the AMC business, the insurance business, both general and life. They've incubated an education business. You've taken companies public as well. So today, if you have to incubate a new business which has a 10 to 15-year highway, what could be that business?
See, in the financial services, most of the businesses that one possibly could have done, we've already done. We have life insurance, we have general insurance, we have specialized education financing, we've got HDFC, we have a bank, HDFCs and mortgages. So virtually every financial service business we could get into, asset management, PMS, so fund of funds, so on and so forth. So every business that we could have, we are there. At one point of time, we looked to see whether we should set up some kind of a reinsurance company, because reinsurance is a big need in India. But after a number of studies, we've just decided to put it on the back burner. So at the moment, there is no plan.
What do you think HDFC has done over the years to widen their moat? Because the home finance business is a very old business. It's a highly competitive business. It's an easy business.
See, when you talk of highly competitive business, yes, it is a competitive business. Banks have been doing housing finance now since the 90s. But notwithstanding the presence of all these banks over the last 25 years, HDFC has never lost its market share. We've never lost our profitability. We never lost our asset quality. If you look at it historically, from the time we started in 1977 till today, over a period of 45 years, our total loan losses on individual loans, non-individual is different. Only on individual loans, money we've not been able to recover, we've had to write off, is only 7 basis points.